So here's going to be the learning objective of this chapter. Kind of like you do the preview first. Um, so this chapter is going to examine the tools used by the Federal Reserve System to control the supply of dollars and interest rate. We already talk about those chapters when we're using the balance sheet and we're using the equation that we talked about in chapter 14. We developed the money multiplier, the simple deposit multiplier, this kind of stuff. Here we're going to use graphs. So we're going to illustrate some market called the market for reserves and demonstrate how changes in the monetary policy can affect the federal funds rate. So the federal funds rate is this interest rate that banks charge each other when they loan themselves reserves or they give them some kind of loans. You know what I mean? Like Bank of America borrow from Citibank. Citibank is going to charge them an interest rate called the what? The federal funds rate. Remember, when banks loan among each other, the interest rate they charge each other is the federal funds rate. But when they borrow from a Fed, the Fed is going to charge them the discount rate. Now, the question that you might be having lingering in your mind is that if banks are the ones charging this interest rate called the federal funds rate, why is the Fed involved? Why does the Fed control that interest rate? So we're going to talk about that because the Federal Reserve, as you saw in the balance sheet, can control the supply of reserves in the banking system using monetary policy. Remember, when the Fed buys bonds, the supply of reserves in the banking system go up. So that is going to be the way the Federal Reserve is going to influence the federal funds rate. Because remember, this is a market. A market, the interest rate or the price in a marketplace is influenced by demand and supply, or what you're talking about. So we're talking about the supply and demand for reserves. And then we're going to summarize how conventional monetary policy tools are implemented and advantages and limitations of each, and then try to explain the key monetary policy tools that are used when conventional policy is no longer effective. So we're going to see that this one, especially going back to the financial crisis of 2007, because the Fed has always lowered interest rate when the economy is in a recession to grow the economy out of a recession, and they raise interest rates when they're at risk of inflation, when the economy is overheated. But what happened in 2007, which we're going to be discussing here, is that when the recession hit, interest rates in America were already at very low levels. And the question then was, how could the Fed lower those interest rates to make them negative? Of course, that's not going to be an answer because we saw this already with the Japanese experience of the 90s. Japan was faced with a serious economic downturn, and interest rates in Japan were really low. Then the Bank of Japan, the Central Bank of Japan, started to print yen and lower interest rate, and interest rates in Japan became negative. So the question is, if interest rates become negative, that's a very interesting economic situation. That's bad. That's what we call a liquidity trap. Because think about it. If interest rates are negative, if you are in Japan in the 90s, that means if you borrow 10,000 yen, you pay 9,000 yen because interest rates are negative. You think any bank is going to loan you money if they know that they're loaning you 10,000, you must pay them only $9,000 because that means negative interest rate. What that means. So the banks in Japan refused to lend, and the Japanese economy fell. So we did not, America did not want to fall into that same trap that the Japanese fell in the 90s. So the Federal Reserve had to come up with because conventional monetary policy wasn't working anymore. Then Ben Bernanke, who was the chair of the Federal Reserve at that time, came up with a series of some unconventional tools of monetary policy that were not tried before, and we're going to talk about those. And then we're also going to identify the distinctions and similarities between the monetary policy tools of the Federal Reserve and those of the what? Those that are implemented by the European Central Bank, the ECB. We talked about the ECB the other time. Okay. This central bank in Europe that is in charge printing the euro, the common currency that is used by a number of countries in the EU. Okay. So let's talk about the demand and supply in the market for reserves. So this chapter is a little technical, and I want you to be careful and follow it because the demand curve that we're going to be talking about here is a little bit different from the normal demand curve that you guys have seen in the past. So let me open a new slide and try to start kind of explaining things here so you understand what I'm talking about. So just be patient with me. I need as many slides here as I can. Okay, so let me go back here. Okay, so here we're talking about some market, some hypothetical market, which is not a real market for reserves, a market where banks lend each other reserves or loans. It's always, most of the time, it's overnight lending, short-term lending, like in 2 weeks, 1 month, stuff like that. So Bank of America can borrow. If Bank of America is in a liquidity crisis, they don't have cash, they can go to Citibank, and Citibank's going to lend them what? Some reserves. Okay. So let's talk about what that market looks like. So we're going to say here the market for reserves. Okay, so you know that anytime we talked about market in economics, we must understand the supply side of the market. So we're going to talk about the supply of reserves in the banking system. And then we're going to talk about the demand for reserves. So I'm going to start kick it off by talking about the demand first, then I talk about supply next. So first of all, we know that there are three interest rates that we are going to try to illustrate in this demand and supply model. Okay, and you already know some of those interest rates. The first interest rate is what we're going to be calling the discount rate, which is notated as ID. So this is the interest rate that the Federal Reserve charges banks, I mean private banks, when the Fed lends money to them. When it lends to them, the Fed is going to charge a discount rate. So that's going to be one interest rate. Okay. The second interest rate that we're going to be talking about, so I talked about the discount rate already. You know, I talked about the definition there. Let me duplicate it here, which is your I is denoted ID. And then the second interest rate that we're going to be talking about is a federal funds rate. And in chapter 9, we also talked about what the federal funds rate is. Federal funds rate. And our notation for the federal funds rate here is going to be IFF. Federal funds rate, interest rate. So this is the interest rate as we define in chapter 9. This is the interest rate which banks in America, private banks, in America charge when they what? When they loan money to other banks between them. When I say loan money here, that you can just say reserves. Banks loan each other reserves between them. So remember, we talked about something that the role of the Federal Reserve plays a critical role as a lender of the last resort. We talked about this. What do we mean by that? That when banks in America are in a liquidity crisis, banks must first try to borrow among each other. Let's say if Bank of America is in a serious liquidity, it doesn't mean Bank of America is bankrupt. They just run out of cash. So Bank of America may try to borrow from Citibank. If Citibank tells Bank of America, oh, no, we don't have it either. Bank of America may go to Capital One turns Bank of America down. They go to Wells Fargo, they go to JP Morgan. So if Bank of America tries to borrow money from other banks and they simply can't find one, then the last place they go to is a Federal Reserve. So the Fed is a land of the last resort. So what does that mean? Because we know if Bank of America is successful borrowing from other banks like from Citibank or from Wells Fargo, they're going to get charged a federal funds rate. But if they can't find money anywhere, they're going to go to the Federal Reserve where the Fed is going to charge them a discount rate. Because the Federal Reserve is a land of the last resort, then by design, the discount rate is always above the federal funds rate. Because if the Fed is providing loans as a lender of the last resort, why would the Fed charge a lower interest rate than what banks would get when they loan among each other as a first resort? So by design, the discount rate, that the interest rate that the Fed charges banks above the federal funds rate. And then, ever since the Federal Reserve was created in 1913, the Federal Reserve, because remember all banks, from a previous chapter, we said that all banks in America have their account with the Fed called the reserve account, where they deposit both excess reserves and required reserves. So if the required reserve is by regulation. So the banks have to keep up a fraction, a minimum fraction, like say 10%. of customer deposit with the Federal Reserve. And then if they decide to keep anything in excess of what the Fed wants them to out with the Fed, that's what they call their excess reserves. So traditionally, if you deposit, let's think about you and me. If you deposit money into your bank account, like let's say in your checking account or savings account, you should expect your bank to pay you an interest rate. So what about banks? Banks should also expect the Federal Reserve to pay interest rate on their excess reserves if they deposit some money in excess of what the Fed requires them by law to keep as a proportion of the customer deposit. Those excess reserves, the Federal Reserve should pay interest rate to banks. But what happened is that between 1913, when the Federal Reserve was created, to until 2008, the Federal Reserve never paid interest rate on excess reserves. But that policy changed in June, and by August, by the fall of 2008, the Fed started paying a small interest rate on bank excess reserve. We call that interest rate on excess reserves, which can be defined as OER. Or sometimes we can just call it interest rate on reserves, just for short, because these are too many, but it's called interest rate on excess reserves. Okay, but that interest rate is very small. It's a very small interest rate that banks pay. So by design, the interest rate on on excess reserve is less than the interest rate on the federal funds rate. And we've already seen that since the discount rate is greater than interest rate on federal, then that means this is going to be less than the discount rate. This is what it is. I'm going to show you in the graph so you understand it. Okay. So let's talk about something which is the role of what? The role of excess reserves on the bank balance sheet. So why do banks keep excess reserves? Or why do we encourage most banks in America to have adequate excess reserves? The reason is, so the benefit of keeping excess reserve, benefit is that excess reserves act as an insurance against deposit outflows. That's the main reason. Against deposit outflow. Deposit outflow is the same thing as withdrawals. Okay, so banks are going to keep some excess reserves so that when a customer walks in, wants to withdraw money from the bank should not tell the customer, oh, we don't have it today. That would be really bad. So that's a benefit. That excess is going to ensure that the bank also has enough money to pay out when customers want to withdraw their money. The cost of this, though, that's a benefit, but the cost, the opportunity cost of keeping excess reserves is going to be the interest rate that the banks are going to forego. Are they lend those money to other banks? Because if the bank did not keep the excess reserves, what does that mean? They could loan those excess reserves to other banks and charge an interest rate called the federal funds rate. Because since the federal funds rate, I'm going to explain that. So the opportunity cost is what you must give up if you choose to hold excess reserves. So you're going to be giving up the what? The interest rate that you should have earned had you lend those funds out to other banks, because that's the federal funds rate. But then we have to subtract from it the interest rate on excess reserve. Why? Because if the banks, look, let me put a number there. Before 2008, this was zero, because the Federal Reserve never paid interest rate on bank reserves. Let's say if this is 5%, that means before 2008, banks would what? The opportunity cost of holding excess reserve was really big. They would lose the entire, because 5 minus 0, the entire 5% is what they were going to be foregoing if the bank chooses to sit on a ton of excess reserve instead of loaning it out. But since 2008, the fall of 2008, the Fed has started paying some small interest rate on what? On excess reserve. Let's just pretend that suppose this is 1%. This is the banks still charge each other what? Which is assuming that this is still what? 5% here. So now you can see that opportunity cost would have narrowed to 4%. It's a lot better, but it's still, there's going to be some cost that the bank is going to charge, even though they aren't, because even if they decide to keep the money with the Federal Reserve, it doesn't pay that much. But if they choose to loan those funds to other banks in a reserve market, they get paid, say, 5%. So it's a much higher interest rate. So the opportunity cost is what they would not earn if they choose to hold excess reserves minus what they get anyway if they keep the excess reserves with the Fed. Okay. All right. So now, having said that, let's talk about the demand for reserves. How do we illustrate the demand for reserves on the what? In a supply and demand context? You guys know the law of demand. The demand. So there are banks that are, this represent the demand side of the reserve market. Banks that are demanding funds, reserves from other banks. Remember the cost of borrowing for other banks, the federal funds rate. So the demand for reserves. The price of reserve is the interest rate. If you choose to borrow, the price you must pay is a federal funds rate. So that means the law of demand is here is going to be that the higher the federal funds rate, which is your IFF, because that's the price you pay when you borrow money from other banks, the lower is the demand. The lower is the demand for reserves. That's the law of demand for reserve in the reserve market, and vice versa. Okay, so I'm going to translate this into a diagram. So the demand for reserves is going to be some demand curve that you have never seen before. Is what it's going to be a king demand curve. That's why this chapter is a little technical. So if I put the interest rate on this axis, interest rate here, versus the quantity of reserves, the demand curve for reserve is going to slope downwards, and then it becomes flat. Something like this. So the notation is RD. This is what we call a kink demand curve. You guys you're used to the demand curve that is always not normally slope downwards. This one is going to be kink at this point. The demand curve slopes downwards, then it becomes flat. So at this minimum point where the demand curve becomes flat, that is the interest rate. The Federal Reserve sets the interest rate on excess reserve at that point. Okay. So now, let's say the federal, because the federal funds rate, remember, is above the interest rate reserve. We said that the what? Interest rate on excess reserve is less than the interest rate, the federal funds rate. And the federal funds rate is always less than the what? The discount rate. We did that. So let's say if the federal funds rate is IFF1, from the law of demand, the higher, because the federal funds rate is the price that the banks pay when they choose to demand or to borrow money from other banks, to borrow reserves from other banks. So when the federal funds rate is high, from a law of demand, you draw a line, you hit the demand curve here, the quantity demanded of reserve is going to be low. You can call this RD1. But when the federal funds rate starts to fall, let's say to IFF2, okay, from a law of demand, the lower the price, the higher is the quantity demanded. The price you pay is the federal funds rate. So when price falls, the price of reserves, you're going to demand more reserves from a law of demand, RD2, because it's getting cheaper and cheaper to borrow money. Banks are they don't want to borrow more. And when the federal funds rate falls further, let's say to IFF3, is when it's much cheaper to borrow. The quantity demanded to reserves is going to go up to RD3. Now, let's look here. Now, suppose the federal funds rate continues to fall. And let's say now it falls and reaches a point where the federal funds rate 4 is equal to this interest rate on excess reserve. Let's just pretend. What do you think is going to happen? And that's the reason why this demand curve becomes king, because the interest rate on excess reserves kind of set a minimum threshold on interest rate. The federal funds rate cannot fall below that interest rate. Here's why. If the federal funds fall and now it's equal to the interest rate on reserves, that means the banks that want to that basically means that the banks that want to borrow money, okay, will be indifferent. Okay, the banks that want to lend money, that are going to be indifferent between lending to other banks. Because when they lend to other banks, they're going to charge a price, what interest rate of IFF4, or they may want to just keep that money with the Federal Reserve. So those banks that want to lend the reserves to other banks are going to be indifferent. That means they earn the same interest rate if they loan those funds to other banks and charge an IFF4, or if they kept that money with the Fed, they're going to earn the same interest rate. But lending money to other banks is riskier. Keeping the money with the Fed is safe. So we're going to argue that once the federal funds rate falls and equals to the interest rate on excess reserves, banks are just going to continue to accumulate their excess reserve with the Fed. So the demand curve becomes flat. So in the extreme case scenario, what about if the federal funds rate were to fall below the interest rate on excess reserve, something which is practically impossible? But let's just pretend. Suppose the federal funds rate falls below the interest rate on excess reserve. And let's say you own a bank and your bank had $10 billion in excess reserve. So your bank was contemplating lending that $10 billion to other banks or keeping it with the Fed. If the federal funds rate falls below the interest rate on excess reserve, if your bank chooses to lend those $10 billion to other banks, that means the interest rate that your bank is going to earn is going to be less than what the bank would have earned if they left the money with the Federal Reserve earning the what? Interest rate on excess reserve. That's why this demand curve is going to be sloping downwards. But once we reach this minimum threshold, the federal fund rate can no longer fall below that minimum threshold. Banks that want to loan money, they're just going to hold on to their excess reserve with the Fed. The demand curve becomes downward sloping and flat. The flat portion, again, as I told you, establishes the what? The interest rate on excess reserves. So that's the demand side. Let's talk about the supply side. Okay, let's talk about the supply side. So in chapter 14, okay, in chapter 14, we talked about there are two ways that the Federal Reserve can control the supply of reserves in the banking system. Okay? Two ways, and we need to distinguish these two ways the Fed can control reserves and monetary base in the banking system. We discussed this at length in chapter 14. Okay? The first one is what we're going to be calling non-borrowed monetary base. So we're going to the notation for this, because anytime you change reserves, you affect the monetary base. We're just going to say we're going to call this now NBR, non-borrowed reserves. So this is when the Fed will uses open market operations as a tool of monetary policy. So when the Fed buys or sells bonds, it affects the non-borrowed reserves because banks are not borrowing. When the Fed buys, let's say, $50 billion worth of bonds from banks, what does that mean? That means banks are the ones selling their reserves to the Fed, but banks have their account with the Fed called a reserve account. So the Fed is going to credit their reserve account with the actual amount of the what? Of the bond purchase. So that's but that reserves that is going to be credited is non-borrowed reserves. That's the one that's going to be affected. So uses open market operation to influence it. That's one way. The second way that the Federal Reserve can control the total supply of reserves in the banking system is through lending to banks, loans to financial institutions. We did this very clearly in chapter 14, loans to financial institutions. So the Fed has two choices. It can either buy bonds from banks if they want to increase the supply of reserves and monetary base, or they could loan money to banks. If the Fed wants to increase reserves by $50 million or $50 billion, they can either buy bonds from banks, then reserves are going to go up by 50 billion, or they can loan money to banks. So, but when they loan money to banks, the component of reserves and monetary base that get affected is what we call borrowed reserves. borrowed reserves, which we're going to be, we denote as BR. This is the NBR is what we're calling non-borrowed reserves. NBR stands for non-borrowed reserves. So that means the total supply of reserves in the banking system can be decomposed into non-borrowed reserves plus borrowed reserves. Okay, so this is how the supply of reserve is. So this is a supply of reserves in the banking system. Consists of what? Non-borrowed reserves and borrowed reserves. And both of this is influenced by the Federal Reserve. Okay, so now let's go and draw, see how the supply curve look like for banks. So we're going to assume that at any point in time, there's fixed amount of reserves in the banking system. Okay, but the Fed can increase, change that, whatever, anytime they want. But at any point in time, so let's talk about it here. We're saying the supply curve for reserves in the banking system. We're going to denote it as RS. And that supply curve also is a king supply curve. Is there a supply curve that probably you guys have never seen before? So we're going to put the interest rate on this axis. Okay. And then we're going to put here, we have the quantity of reserves in the banking system. Okay, so the quantity of reserves in the banking system consists of, there are two. We raise, we're saying that total reserves or quantity of reserves, the supply of reserves in the banking system consists of non-borrowed reserves plus borrowed reserves. So when the Fed buys or sells bond, they will influence this guy. Or if they loan money to financial institution, that affects the borrowed reserves. The borrowed reserve is still part of total reserves. But the supply of reserve is going to be, is basically vertical like that, then it becomes kinked, becomes flat. It's a king supply curve. Okay, so this we're going to denote as a supply curve for reserves. So I want you to follow very well. So the flat portion of the supply curve, this is also what we're calling what? A king supply curve, just like we found a king demand curve. King supply curve. It's not a normal upward sloping supply curve that you guys have seen. It's fixed, then it becomes what? Perfectly elastic. So the flat portion of the supply curve here, this part here, establishes an interest rate which we call the discount rate. And I'm going to explain why that's a maximum threshold. And then from zero, from the origin to where this vertical line touches this horizontal axis, all this quantity of reserves in the banking system are all non-borrowed reserves. Because remember, we're saying the total supply of reserves consists of what? Non-borrowed reserves and borrowed reserves. And then anything beyond this vertical line, see this, I want to look very clear. Anything to the right of this borrowed line, this vertical line, which is represented by this flat portion, that is going to be what we call borrowed reserves. That's why the supply curve consists of borrowed reserves, and anything beyond this line is borrowed reserve. Non-borrowed reserve is up to here, then anything beyond this flat vertical line is going to be borrowed reserve. I can do an example. Let's say if I put a number, let's start from zero up to this vertical portion. Let's say that is $60 billion. And then I say, I put in some number here, say $70 billion. Okay. And then I ask you, what is the quantity? What is non-borrowed reserves here? So your answer is, your non-borrowed reserve is $60 million. 60 billion, million billions. From zero to that vertical line, we level 60 billion. And then from 60 billion, if this is 60 billion, then going to 70 billion, which is now this flat portion of the supply curve, 70 minus 60. So that means borrowed reserves is going to be $10 billion. That's right. You take $70 billion minus what is what? Non-borrowed reserves. Okay, now, but that's not the larger issue. The larger issue, now let's start explaining here. So let's suppose the federal funds rate is IFF1. Because remember, the federal funds rate is always below the discount rate. Okay? The equation, the relationship is here. We talked about that already. We said interest rate on excess reserve is always less than the interest federal funds rate, and the federal funds rate is always less than the what? The discount rate. So the federal funds rate is always below the discount rate. So if this is a price, the federal funds rate, the interest rate that banks charge each other when they loan each other reserves, that means if you draw a line across, you hit the supply curve, banks are going to supply this $60 billion. That's the amount of reserve. What about if the federal funds rate increases to IFF2? The total quantity of supply reserve is still going to be the same on that vertical line. It's still going to be 60 million. But let's say the federal funds rate were to rise and equals to what? The discount rate. So now let's say now IFF3 equals to ID. That becomes interesting. So when the federal funds rate rises and becomes equal to the discount rate, what do you think is going to happen? That means banks that wanted to borrow in the marketplace are indifferent between borrowing from other banks and borrowing from the Fed. So banks are going to be, because you're going to get charged the same interest rate. If the federal funds rate rises and now equals to the discount rate, which will rarely happen, or it doesn't happen at all, banks that want to borrow from the Fed or from other banks are going to find themselves indifferent because the cost would be the same. The interest rate is equal, they're the same. But think about in extreme cases. What about if the federal funds rate ever rises above the discount rate? Something that will never happen. For the most part, it's possible, but it doesn't happen most of the time. If the federal funds rate rises above the discount rate, that means banks that want to borrow money will want to go and borrow from the Fed first, because that's where money would be cheap. If the federal funds rate, so that's what I'm saying. I'm saying that if the federal funds rate, something which is very unlikely, but it's possible, if it rises above the discount rate, that means banks are going to try to borrow from the Federal Reserve because the Fed is going to charge them a lower discount rate, ID. So the Federal Reserve or the central bank is going to lose its critical role as the lender of the last resort. That will never happen. And the central bank will not do that. So once your federal funds rate hits the discount rate here, banks are going to continue to what? They're going to start borrowing from the Fed because it's indifferent. That's what we're saying here. Okay? So they're just going to continue to what? Borrow from the Federal Reserve. That's why the supply curve is going to be vertical and becomes what? Flat. But anytime the federal funds rate is below the discount rate, banks will always borrow from each other where it's cheap. Because that means that, but once that interest rate, they equal up, then banks are going to borrow from the Fed. That's why this portion becomes flat. Okay. So now let's put everything in equilibrium, because markets reach equilibrium. We talked about the demand already. It's a king demand curve. And we just talked about the supply curve. It's also a king supply curve. So when does the market for reserves reach equilibrium? Okay. Okay, let's discuss the concept of equilibrium here. So I'm going to ask the question, when does the market for reserves reach equilibrium? So the answer to that question is a solution is when the demand for reserves equals to the supply for reserves. Remember, RD stands for the demand for reserves. RS is the supply for reserves. So we know that the demand curve for reserves, as we drew earlier, if we put interest rate on this axis, and there are going to be 3 interest rates that we're going to represent on this axis, and then this is going to be quantity of reserves in the banking system, total quantity of reserves, which you can just say comma R, because that's total reserves that can include both what? Non-borrow reserves and borrow reserves. So we know that the supply for reserve we just talked about is upward sloping, is vertical, and then it becomes flat. So king supply curve. So this is your supply for reserves. And we say that the flat portion of the supply curve, when it becomes king tier, establishes the upper threshold on interest rate, which is a discount rate. And then the demand for reserves, we talked about it, is downward sloping, and then it becomes flat. We talked about this. So this is your RD. Okay? And we say that where the demand curve becomes flat, this establishes a minimum threshold on interest rate, and that minimum threshold is what we call the interest rate on excess reserves. So now you can see that if this is from zero, remember we say the vertical line here determines the what? The non-borrow reserves. Anything to the right of that vertical line is what? Is borrow reserves. So the demand curve is sloping downwards and is intersecting the supply curve at this point. That's a point of equilibrium, because equilibrium is where the quantity demand must equal to quantity supply of reserves. So you're going to get something like this. This is going to be like, this is going to determine your equilibrium federal funds rate. Now you can see clearly, that's exactly what we're saying. Now, now you can see that the interest rate on excess reserve is now less than the interest rate, the federal funds rate, and the federal funds rate is less than the discount rate. They're all represented there on this vertical. See, ID is above IFF and IF is above IOER, interest rate on excess reserve. Okay, so I have a better diagram here now. And you can call this, I remember I told you can call it interest rate on reserves, or you can call it interest rate on excess reserves. So it doesn't matter. So we're saying the federal funds rate is always less than the discount rate. Okay. So here's a diagram. So now let's do some kind of demand and supply. So there's only one equilibrium up in at point one when the supply for reserves intersect this demand for reserves. And you can see the flat portion of the demand curve, even though I don't put a dot. If you put a dot line across, that's what determines the interest rate on excess reserves. And then the flat portion of the supply curve here, that's what establishes a maximum interest, maximum ceiling on interest rate. That's a discount rate. Why am I calling it the maximum threshold on interest rate? It's based on the notion that your federal funds rate will never rise above the discount rate. And this is called the minimum threshold on interest rate because the federal funds rate cannot fall below the interest rate on excess reserve. If the interest rate, federal funds rate ever falls below the interest rate on excess reserves, the banks that have excess reserve will continue to just accumulate their reserve with the Fed, because that means they would be indifferent between lending money to other banks and them getting charged an interest. If this IFF falls, let's say you get another IFF here now equals to interest rate on excess. We'll talk about this. Banks without have money, excess reserve, they're going to choose to just keep that money with the Fed, excess reserves, where they earn this interest rate on excess reserve. That's why these things become flat, because these banks are just going to accumulate reserves with the Fed. And then on the flat portion of the supply curve, the banks that are contemplating borrowing from the Fed, if the federal funds rate continue to rise, and let's say it equals to the what? Now equals to the discount rate, what do you think is going to happen? The banks that want to borrow money, they're going to be indifferent between borrowing from a Fed or borrowing from other banks. But what banks are going to do, they're just going to start borrowing from what? We're going to assume that they're going to start borrowing from a Fed, because a flat portion of the supply curve represents borrow reserves. What if the federal funds rate is above the equilibrium, like IFF2? So if you draw the dashed line across, you're gonna hit the demand, the demand curve first. And then that means the quantity demanded at that interest rate IFF2 is low, but quantity supplied is high because it's a supply curve. So this gap here is what we're gonna call an excess supply of reserves in the banking system. Anytime you have an excess supply of something, what happens to price? Price falls, and the price of reserve is the interest rate. So you can see the interest, that's why we drew this arrow sloping downwards, because it's showing that if there's an excess supply of reserves, banks have too much reserves. So there's too much reserves in the banking system. The banks that have those excess reserve can only loan them at a lower interest rate. So the interest rate is going to be forced back to equilibrium until when we move back to this equilibrium. And the converse, if you have the federal funds rate, which is too low, which is below equilibrium federal funds rate, in this case, if you draw this dashed line across, you hit the supply curve, meaning that the quantity supplied at this interest rate is only going to be this guy. But if you continue with a line across, the demand curve is somewhere here. So that means there's a shortage of reserves, or there's excess demand, because the amount by which banks that want to demand reserves, the amount they want to demand exceed the amount that is available for lending in the banking system. So that's what they call a shortage. So anytime you have a shortage of something in the marketplace, that shortage is going to force the market price to rise back to equilibrium. But the price here is the what? The federal funds rate. So that's how you can explain that market for reserve. Now, what we're going to be doing next now, we're going to start talking about how changes in monetary policy affect the what? Affect this federal funds rate. Because remember, the instrumental policy that the Federal Reserve, you always hear, oh, the Federal Reserve has decreased interest rate. Which interest rate does the Fed target? The Fed targets the federal funds rate. Okay. But then I'm going to show you later how can we link this federal, because this federal funds rate is not the market interest rate. It's different from your interest rate, like what? Like the interest rate on a mortgage or car loan interest rate or student loan interest rate. This is different. The interest rate on a mortgage, student loan interest rate, that's what we call the market interest rate. But what you're going to learn is that when the Fed changes this short-term interest rate, which it controls, all other interest rates in the economy are going to change. If they lower, they may not change by the same amount. So if the Fed lowers the federal funds rate by 25 basis points, by 0.25, they decrease it, then that means mortgage rates are going to start falling. Car loan interest rates are going to fall. So this interest rate acts as a signal that all market interest rates need to go in the same direction. So let's talk about the tools of monetary policy, which can what? Affect changes in equilibrium interest rate. Okay. So how changes in the tools of monetary policy affect the what? The federal funds rate. Okay, so let's start with the most important tool of monetary policy that we talked about already is open market operation. We say that's the most popular because the Fed finds it more effective than any other conventional tools. So let's talk about what how changes in the tools of those monetary policy affect what? The federal funds rate. Okay. Now, so for tools of can say tools of monetary policy. So the first tool of monetary policy is what we call, which you already know this from the balance sheet, is open. But now here we're going to illustrate using a graph. We talked about this in chapter 14 at length. Even in chapter 9, if the Fed buys bonds, like a $50 billion bond purchase, I ask you, how do you represent this on the balance sheet of banks, balance sheet of the Federal Reserve? You know this using the balance sheet. And how does that affect reserves? How does that affect monetary base? Here we're going to use a graph to understand that. Okay, so let's say the first main tool of monetary policy is the open market operations, which is what? Open market operation is defined as buying and sometimes selling treasury securities, or just say securities by the Fed. So now I want to do an example. Let's just say what we have been doing, like even in the past. Let's say, suppose the Federal Reserve buys $100 million or $100 billion worth of treasury securities. Let's say, example, something that you did already. I'm going to repeat of chapter 14, but then we're going to show you in the graph. So suppose the Fed conducts a $100 billion bond purchase or securities purchase from banks. So we showed in chapter 14, this is what is going to happen on the balance sheet of, because there are two parties involved here. Banks that are selling their securities to the Fed. The Fed is the one buying. Remember, this is an open market purchase by the Fed from banks. So we're going to see how the balance sheet of the Fed look like. You know this already. So remember, we put assets on the left. We represent liability on the right of the balance sheet. You know that. Assets on the left here, liabilities on the right. So when the Fed buys something worth $100 million, $100 billion. They're buying securities. If you buy something, you gain it. So the Fed is going to gain 100 billion worth of treasury bonds, treasury securities, because they're the ones buying. So it doesn't mean that the Federal Reserve will only have $100 billion worth of securities on its asset side. The Fed rate has a ton, trillions of what? Of assets, including securities. But when it purchases additional $100 billion, that's why we're saying there's going to be addition of what? $100 billion on its asset side. But while the Fed is the one purchasing, you purchase something, you gain it, the banks are the ones selling. So the banks are going to see their securities or their assets that they sold to the Fed decrease by $100 billion. We did this. Okay, so traditionally, if I buy something from you, I need to write you a check or pay for it using cash. The banks don't need to, so the Fed doesn't need to write a check to the what? To banks. Why? All banks in America already have an account with the Federal Reserve called a reserve account. Okay, so when the Fed buys something from banks, the Fed doesn't need to write a check or pay for it using cash. The Fed is just going to credit the bank's reserve account. Reserves are bank deposit with the Fed. They are assets. So the banks are going to be credited with a $100 billion on the reserves. And while reserves are bank assets, they're the Federal Reserve liability. So this is going to be plus $100 billion on this. So that's how the balance sheet is. But now what you have seen here is that there's a change in reserves, which equals to $100 billion. And what type of reserve is this? Remember, we talked about earlier that total reserves in the banking system consist of non-borrow reserves plus borrow reserves. So since this is coming from buying bonds, that means it is only this guy which is affected. This is a guy which has gone up by $100 billion. And that's the reason why this guy went up $100 billion. It's not borrow reserves, because we have not, this question does not tell you that the Fed loaned money to banks. No, they did not. They just bought securities from banks. That means the component of the reserve supply reserves that is going to be affected is non-borrow reserves, not borrow reserves. If the Fed had loaned $100 billion to banks, then well, it is these borrow reserves that would change, not non-borrow reserves. So you gotta follow that. Okay, so now that you know that if the Fed buys bonds from bank, what you call open market purchase, that's gonna increase non-borrow reserves, which is reserves in the banking system go up, but that's specifically non-borrow reserves, meaning that that non-borrow reserves, the vertical portion of the supply curve for reserves, is gonna shift to the right. So now let's go on and talk about it here. So now, so we want to see how this impact what? This is going to impact the federal funds rate. So there are two scenarios. There's case one here. And then there's going to be case two. So when the Fed buys bonds from banks, it is not automatic that it may or may not affect the equilibrium federal funds rate. Let's assume the case one, a case where initial intersection between supply for reserves and the demand for reserves happen at the downward sloping portion of the demand curve for reserves, at the downward sloping portion of demand, the demand curve. Here's a case where we're going to assume that what case two is a case where the initial intersection before the Fed bought bonds. That's what I mean by initial intersection. Initial intersection between the supply and the demand curve for reserves occurred at the flat portion of the demand curve. So there's a difference portion of the demand curve. Because remember, the demand curve slopes downwards, then it becomes flat at a point. It becomes kink. Okay, so this first case here, let's illustrate it. So if we're putting interest rate here on the axis, on this axis, we're putting quantity of reserves in the banking system. So let's say this was my supply curve, which is RS1. That is going to be what? I can call it, that determines the discount rate. Remember the flat portion of the supply curve. And then let's say So now when I say the initial intersection between supply curve and demand curve is happening at the downward sloping portion of the demand curve. Look, see, that's what I mean. See, the equilibrium intersection between supply and demand is happening at the downward sloping portion of the demand curve. So we call this NB what? NB, you call this not, that's non-Bohr reserve. Remember the vertical portion. So this is your NBR. NBR1. That's your initial non-Bohr reserve. And then we're assuming that this is your equilibrium federal funds rate. You can call it one. Remember the flat portion of the demand curve establishes what? The interest rate on excess reserve. Okay. And then here, the initial intersection, if you draw it, we're saying it's happening at the what? At the flat portion of demand curve. So it means interest rates have already bottomed up. The federal funds rate can no longer what? Fall. Okay. So here, the initial, if you draw this curve, what's this? If I draw this thing like this, the demand curve becomes, what is it? This is my demand curve. Okay. Then this is my IOER, interest rate on excess reserve. So here I'm saying that the initial intersection between supply and demand, this is your supply curve, is happy. See, the intersection between demand curve, this is a whole demand curve here, and supply curve, which is this guy here. So this point of intersection is happening at the flat portion of the demand curve. An equilibrium, the intersection between supply and demand for reserves determine equilibrium federal funds rate. So once the intersection is happening at the flat portion of the demand curve, we know the flat portion of the demand curve also determines the what? The interest rate on reserve. That means the federal funds rate, the equilibrium federal funds rate already equal to the what? The interest rate on excess reserve. Here, the initial equilibrium is happening what? At a point on a downward sloping portion of the demand curve. The federal funds rate is not yet equal to the interest rate on excess reserve. Okay, so now let's say, suppose the Fed, the question say the Fed is what? The Fed buys bonds, conducts a $100 billion bond purchase. We know that the non-Bohr reserve is the one that's going to change. So in this case, it's going to shift. By the way, be careful. It's only the vertical portion of the supply curve that shifts, because it's a non-Bohr reserve that is changing, not the what? Not the Bohr reserve. This vertical portion, this flat portion of the supply curve that's another monetary policy tool. That determines the discount rate. So if you shift this flat portion of the supply curve, you are basically doing analysis on a discount rate, because the Fed can either influence the economy either by buying and selling of bonds, or they could lower the discount rate, increase the discount rate, or they could whatever, you know. So we talked about that. So under this case, you only have to shift the what? The value. So the new supply curve is going to be this new line. Plus, of course, that the vertical one, so the flat portion there. The old supply curve is this one, the line which is not very thick, plus, of course, the flat portion. Okay? So the new equilibrium is going to be where the new supply curve, which is going to lead to an increase in what? It has led to an increase in non-Bohr reserve too. So this thing has what? Increased. But the new equilibrium, the point of the intersection is going to be here. That's going to lead to equilibrium federal funds rate falling to IFF2. So this is a case where monetary policy by the Fed, changes in monetary policy, buying bonds, is going to have an impact on what? On the federal funds rate. Federal funds rate is going to fall. What about this case? This case, if the federal funds rate was already equal to the interest rate on reserve, we know this is your initial NBR1. So when the Fed buys bonds in this case, this thing is going to shift to only the vertical portion shift, remember. So NBR, just like here. But the difference now is that once you shift the vertical portion of the supply curve, the new equilibrium is going to be still lying on the what? On the flat portion. There's going to be no change on the what? On the federal funds rate. Because you'll move from this point 1 to point 2. If you draw a line across, that's still the same interest rate. So this is where the monetary policy becomes ineffective. So the impact of an open market purchase on equilibrium federal funds rate depends on the what? On the initial intersection between demand and supply for reserves. If the intersection between the initial demand, this intersection between demand and supply was happening at the downward sloping portion of the demand curve, then yes, buying bonds by the Federal Reserve will decrease the equilibrium federal funds rate. But if the initial intersection between supply and demand for reserves happens at the flat portion of the demand curve, then buying of bonds by the Fed will have zero effect on the federal funds rate. Federal funds rate will not change. That means monetary policy becomes ineffective. Because we forgot to put the flat portion here determines the what? The discount rate. Okay. So that's so what about selling bonds? What about if the Fed wanted to increase the federal funds rate? So now you always hear that the Federal Reserve has decreased interest rate. So let's say this could be like maybe this initial federal funds rate could have been 3%. And then they have decreased it to this lower level to like say 2.5, maybe by 50 basis points. The Federal Reserve knows exactly how much bond purchase or how much change in these reserves in the banking system is warranted to accomplish the goal of lowering interest rate by 50 basis points from 3% to 2.5%. They know. They can predict precisely how much bond purchase they need. If it's $100 billion bond purchase, they're going to buy $100 billion because they want to lower interest rate by 50 basis points. Okay. Now, when we go further, some of you are going to say, this sounds very absurd. Some of you are going to ask me, then who cares? How does that affect me? Okay, I mentioned that. So when you hear on the news, that the Fed has lowered interest rate, like we've seen by buying bonds. How does your interest rate get affected? Your interest rate is what they call the market interest rate. So how does the Fed's purchase of bonds that we have just demonstrated and decreasing the federal funds rate, which is IIFF, affect your interest rate, affect everyday American interest rate, everyday American okay? So it's going to affect everyday solution. It's going to affect our what? Market interest rate. The market interest rate are going to be interest rate like on what? Like car loan rates, car interest rate, student loan rates, mortgage rates, etc. Lending rates by banks. So, but how do we determine that market rates? So remember already in chapter 14, we say, I want you to understand this very well. That's what we call the monetary transmission mechanism. I'm going to talk about it a little bit. So the question, how does your market rates, like your mortgage, go up? Okay, so we need to understand this in the context of money. So in chapter 14, we derived the model for money supply. We're saying that the money supply equals to the money multiplier times the monetary base. Remember this. So, and we're saying the money supply the money multiplier, we derive it, we find as 1 plus C. Just watch the lecture video of chapter 14, all of it, parts 1 and 2. We did all this. C plus R plus E times the monetary base. So the idea here is that when the Fed buys what? The Fed buys $100 million of billion. We talked about that. We know that the change in reserves in the banking system is going to go up by what? $100 billion. But remember, monetary base, as we saw in chapter 14, is the sum of currency plus reserves. So once reserves go up by $100 billion after the Fed has bought bonds, then it means the change in the monetary base is also going to go up by what? By $100 billion. So now you're going to connect that to the money supply because there's a relationship between money supply and the monetary base. Okay, this thing is fixed. This is your money multiplier. It's not going to change. So if the Fed has increased the monetary base, like you've seen here by buying bonds, changing reserves and monetary base, that means money supply is going to go up. And it's going to go up by more than $100 billion because the size of the money multiplier is always above 1. So now the question is, you're going to connect that to your what? To the money market, because money market is what determines the market interest rate. So you're going to say, okay, we talked about this in chapter 19. So this is what we call market interest rate, like the interest rate on a mortgage, interest rate on car loans, interest rate on student loan, and then this is going to say quantity of money. So we know that the supply of dollars in the economy is fixed. You can call this M1, the first one. And then the demand for money is downward sloping. We talk about the money demand. So let's say this was the initial market interest. See, this market interest rate. And let's say this was the initial stock of dollars in the economy. So then remember the Fed has bought bonds. That led to an increase in what? We did the numbers. Increase in reserves in the banking system and monetary base went up. When monetary base went up, money supply goes up. So now when money supply goes up, that means it's going to shift to the what? To the right. Like higher level M2. Stock of money has gone up because the Fed has increased money supply by buying bonds. So you can see now clearly your market interest rate is also going to fall. It's going to fall similar to the fall in the federal funds rate. So the federal funds rate is not the market interest rate, but it's a signaling interest rate. But it's not going to fall by the same amount. So if the Fed lowers the federal funds rate by 25 basis points, the market interest rate, which is the interest rate on a car, interest rate on a student loan, interest rate on a mortgage, may fall even maybe way more than that, or may fall by very limited amount. Depends. So anytime you see the Fed, the news is that the Fed has lowered interest rate, know that all other market interest rate in the economy will start falling. If the Fed has increased interest rate, federal funds rate, which it controls, all other interest rate might go up. That's just the way it is. Okay. So I did that. My diagram look a little bit ugly, but but I drew it here using a computer, so you have everything here. So this is exactly what we talked about. The first case, open market purchase. The impact depends on whether the initial intersection between the supply of reserves and the demand for reserves happens at the downward sloping portion of demand curve. Point 1, that's the intersection between demand and supply before the Fed bought bonds. We also talking about initial intersection between the supply and the demand for reserves happen at point 1. So the federal funds rate was IFF1 and the quantity of non-borrowed reserve was NBR1. And once the Fed buys bonds, remember I told you very clearly, it's only the vertical portion of the supply curve that shifts. The flat portion here stays intact because that flat portion is another monetary policy tool that determines the discount rate. So please make no mistake. Don't shift this curve like this and draw another flat portion. No, that means you're looking at the Fed is changing two monetary policy tools at the same time. That's going to be confusing. We're going to do one at a time, holding other monetary policy tools constant. When the Fed is buying bonds, holding all else constant, is only the vertical portion of the supply curve that shifts to the right. So they can see the new equilibrium is going to. So your new money supply curve is going to be this red line, including the blue flat line. The old supply curve was the solid blue vertical line, and the solid blue flat portion of that line. Okay. Okay, what about the case when if the initial intersection was already happening at the flat portion of the demand curve? I already talked about that. That means the federal funds rate already equal to the interest rate on excess reserves. So buying bonds, which shift the non-borrowed reserves to the right, is going to have zero effect on the federal funds rate because the new federal funds rate, IFF2, is happening at 0.2. That's going to be the same as the initial federal funds rate. So monetary policy is going to have an effective impact on the federal funds rate when interest rate are already bottom up, meaning that if the initial intersection between supply and demand were already at the lowest bound interest rate. And then you can do, what about if the Fed had conducted an open market sale instead? Let's do that because I did not do that here on the drawing with this fancy looking nice, beautiful. What about if the Federal Reserve had conducted an open market sale? Open market sale is the opposite of what? Open market purchase. Okay, so let's do that because I don't want to lose anybody. Suppose the Fed had conducted an open market sale of $100 billion instead. So instead of buying, the Fed was actually selling. So you know that on the balance sheet, you know that, I don't have to be doing this. You already know this from chapter 14. And then you have the Fed here. You can represent that, assets, liabilities on the right-hand side, assets of banks on the left, on this T account, liabilities on the right-hand side of the T account. So if the Fed buys $100 billion worth of securities from banks, if you're buying, they're selling. Question said selling, conducting an open market sale of securities, $100 billion to banks. They're selling it to banks. The banks are the ones buying. If Fed is selling, they're losing it. So there's going to be, you have to debit the Fed's asset here by $100 billion. But banks are the ones buying this time. So the securities of the bank is going to increase by what? $100 billion. Okay. And then traditionally, if banks are the ones buying these things from the Fed is one side. Traditionally, when you buy something from somebody, you got to pay for it using cash or you carry a check. The banks don't need to carry a check to the Fed. Why? Because banks already have an account with the Federal Reserve called the what? The reserve account. So when banks buy something from the Fed is just going to debit the bank's reserve account by $100 billion. So if the balance sheet of the banks was still balancing before, they should still balance because we added something worth $100 billion and we turned around and subtracted something worth $100 billion. If it was balancing before, it should still balance. Meanwhile, while reserves are the bank assets, they're the Federal Reserve liability. So we're gonna subtract $100 billion. So the monetary liabilities of the Fed will go up. So in this case, you can see that reserves is gonna change by $100 billion. So what is this reserve that has changed? Because remember, this total reserve equals to what? Non-borrow reserves again, plus borrow reserves. When the Fed sells or buys bonds, it's the non-borrow reserves that has changed. So you could argue that this change in NBR is negative $100 billion. Negative, not positive. Well, negative $100 billion. And the change in the monetary base will also go down by what? $100 billion because reserves are part of monetary base. Okay? So in this case, if we draw the diagram, to represent it in that supply and demand for reserves, because we know non-borrow reserve is decreasing in this case for open market sale. Okay, what's going to happen here? I want to try to squeeze all of them here so that you, okay. So this is going to be case one, then this is going to be case two. Case one is where we're assuming that one. So you have interest rate on this axis. That's too big. This is going to be quantity of reserves. This is interest rate. Also on this axis, quantity of reserves. So we're going to draw a case where the initial intersection between demand and supply, this is your demand curve one, happen at the what? The downward sloping portion of the what? Demand curve. This flat portion determines the discount rate. Then this equilibrium determines, that's your initial, where the Fed was targeting the federal funds rate before the Fed bought bonds. And then this flat portion here, of course, determines interest rate on reserves or excess reserve, whatever you want to call it. And then this vertical portion, I didn't draw it very nice, a little crooked, should be vertical. This vertical portion determines your non-borrow reserves, remember. You can call it NBR1. So now when the Fed sells bonds here, that we know that leads to a decrease in the what? A decrease in the non-borrow reserve, meaning that the supply for reserves in the banking system has fallen, right? Because we're going to see to like maybe somewhere NBR2. So this curve is shifting. Only the vertical portion shifts. So it shifts to the left. So the new equilibrium is where the black line and the red line on top here is a new supply curve. It's going to intersect the demand curve, which is a whole red line at this point. So you can see this is going to lead to the what? An increase in the equilibrium federal funds rate from IFF1 to IF2. So you know that. Meanwhile, in this case, this is a case where the initial intersection between the demand curve, let me use a rate for now, so it's consistent. It's hard to draw this diagram on a computer screen. It's crooked, look at chicken leg. Okay, so this is your demand for reserves. So what I'm saying here is that, what about if the initial intersection between, this is was your supply curve. The vertical portion there determines the discount rate. So see, so interest rate, the equilibrium here, remember this is your NBR1. So that means the interest rate on reserves rate equals to IFF1. Because, it's right? Yeah. So in this case, if the Fed, no, this depends on how much bond the Fed is selling. If they sell just a little, it's possible that this curve might shift to the left like what? It could shift to the left like this. Go in black. So you fall up here. The interest rate may not change. So, but if they sell a lot, if the Fed sold a big portion of their securities, it depends on how much you shift of this line. If you shift this, it's possible if you shift this curve a lot to the left, then interest rate is going to jump to the what? To this higher level, like IFF2. So on a second. Igbo, did Steve respond? Did Steve respond? I didn't check. Okay, I think it did not. I'm recording lecture. Can we meet down at 6:30 for dinner in the lobby? All right, okay. All right, later. All right, so sorry about that. I was talking to, okay, so there you go. So you can see in this case, it depends on how much the Fed is gonna sell. If they sell just a little bit of those securities, it's possible that the federal funds rate is not gonna change. But if they sold a lot in this case, it could raise the federal funds rate. So here, that is open market purchase. Then the other tools of monetary policy. What is the second tool of monetary policy? Is the discount rate. We can also illustrate using this diagram how changes in the discount rate. Okay, so now look, the changes in the discount rate may or may not affect the federal funds rate. It depends on the initial intersection between demand and supply for results. So on the first case, see, we say that the flat portion of the supply curve, if you do a supply, this supply curve here, you can see clearly that the flat portion is going to determine your discount rate here, ID1. Okay, so when the Fed lowers the discount rate, that means you only shift the what? The flat portion of the supply curve. So your new supply curve is going to come to this blue line up to the red line. See, now that's why I label RS2 here. See, the arrow is pointing down, meaning the Fed has lowered the what? The discount rate. So if the initial intersection between the demand curve and the supply curve is happening at the downward sloping portion of the demand curve, lowering the discount rate may not have any influence on the what? On the equilibrium federal funds rate. Because look at it. If banks were charging each other, let's put a number there. If this was 2%, and let's say the Fed was charging 6% to begin with, if the Fed lowers its discount rate to 4%, banks are still going to, that's not going to affect the equilibrium federal funds rate here. But why? Banks are still going to continue to borrow from among each other where it's cheaper, 2%. So that's going to have no impact on the what? On the federal funds rate. So when we teach you principles of macro, we create it because it was at that level. That when the Fed lowers the discount rate, banks are going to borrow from the Fed and money supply is going to go up. That may not be true. That's why actually loans to financial institutions is a very ineffective tool of monetary policy. Because the Fed is not going to lower the discount rate and make it be lower than the what? The federal funds rate. Because any central bank that lowers the discount rate below the federal funds rate loses its critical function as a lender of the last resort. No central bank will want to do that. So even though the Fed has lowered the discount rate somewhat, equilibrium federal funds rate is still below that what? The new discount rate. But on the second case though, if the initial intersection between the supply and the demand for reserves happening at point one meaning that the initial intersection between demand and supply is happening at the flat portion of the supply curve. Point one, that's flat portion of the supply curve. Here, it's happening on the vertical portion of the supply curve. So, but here, the initial intersection is happening at the flat portion of the supply curve. So that means the federal funds rate already equal to the discount rate, because the intersection determines the equilibrium federal funds rate. The flat portion also determines the discount rate. So that means interest rates were already the same. The discount rate and the federal funds rate are already equal. So in this case, if the Fed lowers the discount rate, the new equilibrium is going to move from this blue line to the passing through this point 2. You see that? It would intersect the demand curve at point 2. So in that case, so that's going to lower the federal funds rate and lowers the discount. So that's the only way lowering the discount rate is going to have an impact on the what? On the equilibrium federal funds rate. But in this case, on the left, there's no impact. And how does the Fed raise the discount rate? Raising discount rate means you shift this curve like this, upwards. Or if it was high here, you shift it like this, it's not going to have any effect here. But here, once if they were already equal, then if you increase it, then the new equilibrium is going to be here. So it just depends. Okay. So that is a discount rate. What is the other tool of monetary policy again? The reserve requirement ratio. Remember, we talked about the tools of money. The Fed sets the required reserve ratio. In chapter 14, we call that R. Typically, they put it at 10%. What's the required reserve ratio? It basically determines the minimum reserve requirement that from every customer deposit, banks should keep at least a fraction, like 10% must not be loaned out. Okay, so if the Federal Reserve decides to jack up that rate from, if they raise the required reserve ratio from, like, say this was the initial one to R2 is now 20%, what do you think is going to happen? That can put, so if there were banks that were only keeping 10% in minimum reserve requirement, the Fed surprises them tomorrow and say, okay, from today onwards, the required, you must keep 20% of the all customer deposit as required reserves. Some banks might be caught in a, in liquidity problem. Maybe some banks were only maintaining the 10% what reserve requirement. Now they have 20, but they may not have that money. That means that's going to lead to an increase in the demand for reserves, because banks that don't have enough reserves are going to start demanding reserves because the Fed wants them to have that money on deposit with the Fed. That's why the demand for increasing the federal funds rate, increasing the reserve requirements is going to lead to an increase in the demand for reserves in the banking system. Banks are going to start demanding reserves to meet that minimum reserve requirement. But keep in mind, though, if you're shifting the demand curve for reserves here, you only shifting the downward sloping portion of demand curve. The flat portion does not shift. The flat portion is another tool of monetary policy, which is the interest rate on what? On excess reserve. So you only shift the downward sloping portion. So in this case, the new equilibrium is going to move to 0.2, where the federal funds rate is going to what? It's going to rise. And the Fed can also, what about if the Fed lower the discount rate from 10 to 5%? That would lead to a decrease in the demand for reserves. So this thing will shift like this. But then you have to maintain the what? You have to maintain the so it could shift like so that would potentially lower this thing almost to the interest rate on reserves. This is when they decrease the reserve requirement. The demand curve, only the downward portion would shift downwards like that. And then the last tool of monetary policy, the one that the Federal Reserve started in 2008 that I discussed, changing what? They can paying interest rate on excess reserves. That will depend, okay, changing the interest rate on excess reserve may or may not have effect on the what? On the equilibrium federal funds rate. If the initial equilibrium between demand and supply for reserves was happening at the downward sloping portion of the what? Of the demand curve, which is this point here. Point 1 is on the downward sloping portion. That's why the intersection happened between demand and supply. If you the Fed increases the interest rate paid on reserves, this flat portion shifted upwards to that was going to raise the interest rate paid on reserve. That's not going to impact this equilibrium federal funds rate. It will have zero effect. But in this case, if the initial intersection between the demand and supply for reserve is happening at the what? Is happening at the flat portion of the demand curve. It means, first of all, that the federal funds rate and the interest rate on excess reserve are already equal. So raising the interest rate on excess reserves by shifting the downward sloping portion of the demand curve upwards also increases the federal funds rate, because the new equilibrium is going to be at 0.2. Equilibrium determines the federal funds rate, but the flat portion of the demand curve determines the discount rate. Sorry, the interest rate on excess reserves. So those are the tools of monetary policy that I want to talk about here. So this is part 1 of this lecture. When I'm going to take a break, and then I'm going to record the second part. The second part is basically a few other addition to this, and I'm going to, because when I come back on to Austin tomorrow evening, I'm going to record the last chapters, the last chapter, chapter 16, on Wednesday. It takes on about 45 minutes of recording. And then tonight, I'm going to put at Canvas already the review sheet, and I'm going to probably assign assignments tomorrow morning. I think there's 1 or 2 homework and one homework and 1 quiz that is remaining. I'm not sure whether it's only one remaining. We'll see. I think it's one homework and one homework. I'll assign those. They're going to be based on this chapter 15 and chapter 16, which I'm going to cover on Wednesday morning when I come back in office. So I'll see you again. I'll take a 10 minutes break, and I'm gonna come back and complete this last portion of this chapter. It's not a lot remaining. Okay, it's gonna take us like 30 minutes. Thank you.